the opportunity for funds is that if they can grapple with the short-term asset allocation versus the long-term view, and they can put themselves in a position where they can actually take advantage of some of the downside of this market. And I think it's the old dollar averaging situation.
No one likes to see their balance go backwards. As a result, and given our membership being under the average age of about 30, for us it's a great opportunity to educate members about what is happening and what is going on.
When things are going great, you tend to not worry. Now that things have gone a little bit dire, maybe people will engage in their super a little bit more and actually take some interest.
We'll be looking at listed assets as well as unlisted assets going forward. We currently hold about 2% unlisted, which is very low by peer standards. So we're looking for buying opportunities going forward.
I think it's ironic that over the last decade or two, we've felt that regulation has hindered our progress rather than helped it. But now, ironically, we're saying thank goodness for regulation.
Despite the economic crisis that we're currently in, real estate remains a very viable and important investment class.
I think the big challenge for funds is to actually engage with those members who need our help right now.
It's a huge savings pool. It does help investment in the economy. It's good for the economy and it's good for jobs.
The silver lining out of all of this, I think, is a deleveraging of economies all around the world, a reduction in debt ultimately. Some pretty hard lessons for those of us in the financial sector about speculation and about letting highly structured products get away from us. So I think there are some learnings, and of course every bear market ends. We're just waiting for when.
So the start of this year has been continued to be difficult. Maybe today is the start of better things.
It's a massive opportunity for people to start doing things differently, like from school systems to medical systems to how we run our government.
Cycles go up and down, so I'm not looking at retiring anytime soon, so yeah.
Wouldn't matter what you're invested in at the moment. It's not a good time to start swapping things around or pull money out of one place and put it in somewhere else because you think it's better, because you lose too much by doing it.
I think this is a fantastic opportunity for Generation Y, principally because it makes us stay in our jobs for longer than 5 months before we piss off to London. Secondly, we have to make sure that the baby boomer bank that we've been withdrawing from for so long doesn't run out of cash, because I hear it's running a bit low lately. And finally, we're learning these lessons at the start of our working lives. I mean, God help us if it happened at the end of our working lives. Oh yeah, right.
It appears that maybe just everyone just sit there and just watch your money dwindle out the door, and you'd be happy to accept that. And I think a lot of self-funded retirees are thinking, they've done the right thing, and now there seems to be no help from anyone. The government is helping, I must admit, but there seems to be no help from the actual financial advisors who handle your money continuously.
It's been a rude shock to many of us in Australia that we're not as independent of the fate of the US economy as we might have thought even 12 months ago. In fact, we're far from immune. So, what does the rest of 2009 hold in store? What are the implications for investment strategy? And what is the state of play for superannuation returns this year? I think you can see we have the bones of a very good discussion here this afternoon from some well-respected industry players. So I'd invite Dr. Shane Oliver to step up to the podium, if you would, to make your initial comments, and then Dr. Doug McTaggart. We might have a brief discussion and then move on to Fiona's presentation. Thanks.
There were two women walking through the bush, and this frog yells out to one of them and says, "Help me, ladies. I used to be a fund manager, but this evil witch turned me into a frog, and if one of you give me a kiss, I'll be turned back into a fund manager." Anyway, one of the ladies quickly grabs the frog and shoves it into her handbag. The other lady screams and says, "What are you doing? If you give him a kiss, he'll turn back into a fund manager." And the first lady says, "Well, a talking frog these days is worth more than a fund manager." And we could say that, I guess, about lots of people in the finance sector. But it has been a pretty tough time. I think at the core of it is debt and deleveraging and the fact that we don't save enough. This has been an issue that's been around for a long time. A year ago, I would have thought that the crisis we were going through would have been over a lot quicker, and the real problem was coming a few years down the track. But obviously, the problems we have had have triggered off a major crisis in particularly the Anglo countries, who have built up debt over many years and haven't been saving enough. So if you look at those two charts there, the one on the left shows household debt as a percent of household disposable income. The US is in orange colour. So that's up there, orange colour. The black is the UK and the blue is Australia. The chart goes back to 1970 and you can see the steady rise in the ratio there, particularly in Australia, from about 1990 onwards, when there was about $40 of household debt for each $100 worth of household disposable income. Today it's about $160 worth of debt for each $100 worth of income. So massive rise in gearing in the household sector, and of course that went hand in hand with a massive fall in savings. So what was going on through that period was basically a combination of very easy credit flowing from the period of deregulation in the financial sector, the fact that I guess attitudes towards credit and debt had changed from my parents' generation, who grew up during the Great Depression and World War II, wanted to save, to a generation, I guess more recently, which doesn't want to save, largely because they can go to one place, get a job. If they don't get what they want in terms of salary, they'll just move on to the next place. Now, the other thing that happened was that wealth gains were very strong through the 80s and 90s and then more recently, so you didn't need to save. I think a lot of that is now going in reverse. The easy credit environment has changed, I think, fundamentally, and that's going to remain a lot tougher for some years to come. And the attitude, you also see an attitudinal change. That generation that sort of come into the workforce, not having experienced a recession, will suddenly see one. And on top of that, wealth gains have slowed right down. So I think whichever way you cut it, the savings rate is going up. The real issue is here how quickly. The thing that obviously concerns me is that those debt levels are still very high, and you can make an argument, yes, we're going into a Great Depression on the back of all of that. I think the counter-argument is that governments have realised that there is a problem and are acting very quickly. So whichever way you cut it, Australia is going to be affected by this. We haven't yet gone through the adjustment. I think we are going to have a pretty tough time over the next 12 months. But I am heartened to see that this is very different to the 1930s. Now, I know there is a view coming from the Austrian School of Economics, or supporters thereof, who seem to think that Hoover, the president in the US who was there in the first part of the Depression, was very interventionist. I think the reality was that they were not. US interest rates actually rose initially after the Great Crash. The US government initially raised tax rates to try and balance the budget, and they stood by and let over 5,000 banks go bust. That is very different to today. If you want to find reasons for the Great Depression, adding in, of course, protectionism, then they rest with those things. This time around, you haven't seen that. American depositors are seeing their deposits protected. This is not a rerun of the Great Depression. Yes, it's going to be tough. Yes, it's going to be the worst recession since, in the last 70 years or so. But I don't see a rerun. Interest rates have fallen very quickly this time around. Very different story to what happened in Japan in the 1990s or the US in the 1930s. Governments have been guaranteeing bank deposits. Very different story again to the 1930s. And of course, we're seeing massive fiscal stimulus up front, not 4 years after, which is what happened in the US with the New Deal when Roosevelt came along in 1934. So I think things today are radically different to the 1930s. Yes, the circumstances leading up to it are similar, but I think the reaction is radically different, and therefore I don't see a rerun of the 1930s, even though it's going to be fairly tough for a while to come. One thing you've always got to remember is that the yield on Australian shares has gone up. Historically, the dividend yield is now above the bond yield for the first time since the mid-1970s. So back in 1973, 74, we had that massive collapse in share markets, 59% fall in Australian shares. Back then I was sort of 13 years old, fantasising about Marsha Brady, whose book I'm currently reading, or actually Maureen McCormick's book I'm currently reading. But the point is, if you'd bought shares back in 1974, at the time the Brady Bunch was cancelled, in Australia it sort of ran on for a little bit longer, you would have done pretty well. You would have got, and the numbers are up there, 23% per annum over the next 10 years. Inflation was about 12% over the next 10 years from mid-74. If you'd bought in 1930, the start of the Great Depression, you would have done extremely well. Again, the yield back in 1930, you can see in that chart there, was very high. Alternatively, if you'd bought in 1990, two of our major banks were on the brink of going bust. Most of our TV stations were insolvent, or the top three anyway, there's only three, commercial networks, and we had Pyramid Building Society and most of the state banks going bust. So terrible time, and if you'd bought shares in 1990, you would have got 13.6% per annum for the next 10 years. And inflation for the next 10 years was 3%, so a real return of almost 11% per annum. Now, I'm not saying this is any guarantee that we've seen the bottom in markets. I think it's going to remain rough for some time to come. But history does tell us that when you see these sorts of falls and your yield goes shooting up through the roof, even though companies cut their dividends, as they did in 1930, 74 and 1990, you normally did pretty well over the next 10 years. So key is to focus on the long term. Obviously, what we've gone through will have some impact. I think we are going to see more regulation, and we're already starting to see that. Reagan came in 1990 and said government was the problem and proceeded to boot them out of the way. The pendulum swung arguably too far in favour of deregulation. Now we're seeing a swing back the other way with Obama coming in 2 months ago and saying government is the solution. And risk is that pendulum swings too far in favour of re-regulation. So that's an issue to keep an eye on. The financial era, I think, has come to an end. It's been easy gains for this industry since the early 1980s. I think, as Glenn Stevens said a little while back, we're coming into an environment where banks will go back to being the handmaiden of industry as opposed to being a wealth generator in their own right. We're also going to see more savings in Anglo countries. I think this will be a major theme over the next 5 to 10 years. Investor scepticism with shares, I think that's something we all have to deal with. We've had 2 major bear markets in US shares and Australian shares in the last 8 years. Back to basics investing. At the end of the day, there's really only 4 asset types. Equities, yes, you can break it up into Australian equities, global equities, emerging and so on. Bonds, directly held property and maybe infrastructure, and of course cash. Everything else is really some derivative or some combination of those two, and I think we should probably stop trying to kid ourselves that by having this thing, which is a mix of the two, we've got something different. And as we saw over the last year, they all came down together, unless it was an unlisted asset, which of course has their own issues because they lag the cycle to some degree. Strong Asia. I think Asia is the place to be going forward. It doesn't have the debt problems. Valuations look extremely cheap again in that part of the world, and their governments have the wherewithal and the motivation to get things moving again. And finally, I think we're coming into a world of more macro volatility. We went through a period there called the Great Moderation, relatively stable macro conditions. I think it's going to be somewhat more volatile going forward.
Thanks. Dr. Shane Oliver, thank you for that. Just for something different, Dr. Doug McTaggart has a different view.
I'm just going to make 6 points, and I'm sure they'll come up in further discussion going on, and not all of them agree with Shane. First point is this financial crisis is not a breakdown of the capitalist system, in my view. It doesn't require a new system to be developed. It is a result of a gross failure to regulate capitalism. I don't think we need more regulation. I think we need better regulation, or better regulators. Second point, we are enduring the worst recession since the Great Depression. And I think it's the result of households choosing to stop spending, and collectively they have created the paradox of thrift. I think there are 3 ways we can think about the transmission mechanism from the financial crisis to the real economy. The first one would be a more traditional recession kind of mechanism. Activities running away, central banks tighten monetary policy, push rates up, cost of capital goes up, firms cut back on investment, unemployment rises, rising unemployment spooks households and they stop spending. I don't think we've seen that. In fact, we've seen the reverse. The household deleveraging story, I disagree with Shane on this. I do not think it is a household deleveraging story at all. It's not a corporate deleveraging story. It is very much a financial sector deleveraging story. At the end of this episode, the financial sector globally will be half the size that it was and will probably stay there for a while until it all runs away again. In my view, the third and most important reason we have this recession is that households maintained their nerve from 2007, or in 2007 when the subprime crisis broke through to the Lehman Brothers fallover when credit markets seized up in September 2008, and then finally shut up shop. They'd simply had enough. And they have chosen to stop spending. Collectively, therefore, we have the paradox of thrift. Point number 3, this recession will end when households feel comfortable enough to start spending again. When the flow of bad news from this negative multiplier working through the real economy eases and slows, when Bob goes home and says to Madge, or Madge goes home and says to Bob, I don't think I'm going to be fired, then that discretionary purchase we put off 6 months ago, why don't we go and get some of that? And gradually that will wind back up. Fourth, East Asia, and in particular China, will not save Australia nor save the world. In fact, the world is required to save them. They are high beta economies. Decoupling is an absolute myth, always was. As Paul Krugman said, you can't believe in both decoupling and globalisation at the same time, and we can go into details as to why. Asia doesn't have a debt problem, Shane. I'm not sure how much debt do Chinese banks carry. Does anybody know? At least in the US we know how bad they are. In China we have absolutely no idea. 5, the various stimulus packages mooted and enacted will have little effect on spending in time. And 6, we are creating big problems for the future, the not too distant future, in particular potential inflation and the overhang of the current debt burden being built up by governments.
Thank you very much. Now, Fiona, if you'll just bear with me, I'll get you to join in just a second. We've heard in our earlier session from Rob Zink, and there's a lot of buzz about his sort of forecast of a depression. And I'm therefore interested to get your views both on what he had to say and then just a bit of a feel from two eminent economists about where this economy is going, because we're all interested in that. So let me just start with you, Shane Oliver. Are you saying that it's not a depression, or it's not the same as 1929 because we're dealing with it differently? Which one are you saying?
The latter. I mean, left to its own devices, yes, we could slide into a depression, but I think the policy action that we're seeing globally and in Australia will head that off. And it's also worth noting in Australia that we have moved very quickly. Normally we wait till recession is confirmed. This time around there's still scope for a debate as to whether we will have a recession or not. I think the Prime Minister only this morning is conceding we probably will.
What do you think?
I think we're already in one, and it's going to go for another 6 or 9 months. But the quick action by the authorities will head off a long-lasting depression-type scenario. I mean, I would agree totally with Doug there that it will end when people feel confident again to start spending. And obviously the huge reduction in interest costs, the payments to households will bring forward the time when they will feel confident again, and people will balance out, well, maybe I'll hang on to my job after all, so maybe I'll buy that car that I was thinking of buying 12 months ago. So that will happen and then we will get the recovery. But that said, it is still going to feel pretty bad. We're looking at unemployment maybe going to 9% next year, 7% by the end of this year, and probably a recession almost as bad as what we had in the early 1990s. So it's going to feel pretty bad for a time in Australia. We're not going to get out of this thing. And there is a degree of vulnerability here that we can't ignore. We did take on a lot of debt. But I would have a leaning towards the view that government action will head off a blow-up on that front.
Just one more question on Rob Zink's perspective on all this. The key to his argument seemed to be that in a traditional recession it's tightening up of monetary policy that kind of gets you into the situation, and it's easing of monetary policy that gets you out of it. We've had a 525 basis point easing in the United States with no discernible impact on that economy. You know, it's like you put the things on like they do in emergency and yell clear and nothing happens. It's just a line across the monitor. And among a much more complex argument he's putting forward, that is at the heart of why he says it doesn't act like a recession, because it must be a depression because it doesn't act like a recession. You're nodding your head, Doug. Well, just Shane, can I get your response?
I mean, it is very different. I mean, normally economists would call it an inventory cycle, you know, where you have strong conditions, companies start building up inventories, but inflation gets out of hand, central bank puts the brakes on, companies don't believe it initially, so their inventories go through the roof initially, then they realise there is a problem, they have to cut back, and then all that has to happen is inflation comes off, the central bank takes the brake off again, and companies have to start rebuilding their inventories and return to normal production. That's the normal cycle. But through history, occasionally we have had banking crises, so that's what we're going through now. We do have an element of a normal cycle. Inventories in the US certainly got to levels that were a bit too high, and we're certainly seeing, I think, a normal cycle in China, normal inventory cycle. But overlaid in the US and UK and elsewhere is this banking crisis, which makes it a lot deeper than normal and a lot more scary. You know, the US sort of fell 6% on an annualised rate last quarter, and it's probably going to do the same this time around. So it is going to feel a lot worse than has been the case in the past. And of course all countries are falling at the same time, so they've all fed on each other. So there's certainly those risks there, and they're the sort of risks that those thinking we're going to see a depression are referring to. But I think governments have realised the problem. We haven't seen interest rates come down as quickly as they have this time around in the US. Certainly in Japan, it took them from the Japanese share market peaked December 89. They didn't get to zero interest rates until 1997. They didn't start quantitative easing, which is being talked about now, till 2001. So this time around you've had much quicker interest rate reductions in the US and a much quicker shift towards quantitative easing where they start pumping cash into the system. And of course already the US is moving towards a policy, it's taken them 6 months too long I think, of trying to remove the bad debts from the banking system. So yes, it's different, it's not the same as the past. They have to do more things than in the past and do it more aggressively. One thing lacking so far has been dealing with the bad debts in the banking system, but I think they've finally got the point there. And tomorrow or tonight they'll announce more definitive moves on that front. So I think it's policy action which will head off depression.
Doug, to you, just that final point on what Rob Zink was saying. You know, it's not a recession because it doesn't act like one, and he used as one bit of evidence for that the easing of monetary policy isn't having a discernible effect. You're nodding your head no, shaking your head no to that. Why?
No, I think he's right. It is not caused by traditional tight monetary policy, and unwinding of tight monetary policy will get you out of it. I think this will be short, sharp and deep because people have chosen to stop spending first.
So in your analysis, this is not Paul Keating's the recession we had to have. This is the recession, in a sense, we are choosing to have. Is that?
Yeah, well, perhaps. No individual chose to have the recession, but all individuals made the same choice at the same time because they face exactly the same external environment. And they all acted individually, but collectively the outcome was the same, and the paradox of thrift argument then follows through. I think what's different in my view, and Shane might be right, 6 months of bad news, and then it turns around. But there's a lot, if you believe the household deleveraging story, which I assume someone like Rob Zink does, then there's a view that we'll have sub-trend growth for the next 50 years until we actually unwind this burden of debt. I don't think so. I think we'll get back to relatively trend growth very quickly, sometime next year, even if unemployment is rising, because it always lags, because I don't believe it's households that are the problem in terms of their burden of debt.
So, just in terms of some baseline predictions, 8 or 9% unemployment, Shane Oliver said. Your view on that?
Yeah, I mean, I can see where that number comes from. I mean, in past recessions, 82, 83, 1991, unemployment typically rose by about 5% from trough to peak. And starting at around 3.9 this time around, you'd come up with 8.9 or 9% sometime 30 months from when it started, and unemployment started to rise in late 2007. So you'd say around about 9% by middle to 3 quarters through next year. However, unemployment rose in those traditional recessions because of the policy that initially drove it into recession. We haven't had that this time around. Therefore, that to me mitigates the extent of the rise in unemployment. And secondly, I mean, are labour markets any freer today than they were 20 years ago? And if they are, perhaps there's a difference there. So I think 9% is a worst case scenario, and perhaps we won't get there.
And when do you think we'll turn around, just very briefly?
I think growth will turn around. Negative growth will go back to positive growth later this year.
Later this year? That's very optimistic. All right, Fiona, thank you for your patience. I just thought you might want to hear what these folks had to say. I noticed that outside everybody was sort of discussing this zinc scenario and what they thought of it, and they found it very troubling, but it certainly got us thinking. Fiona, would you like to give your presentation? I think it's called How Do We Position Our Portfolio, which I think is the point.
I haven't got a Brady Bunch story, but I will confess to having a bit of a crush on Bobby. But I watched the reruns. I never saw them when they first came out. Because I was too young in 1974 to have a crush on anybody. What I wanted to talk to you today, I'm not an economist. I actually did I did some economics, but I ended up moving into asset consulting pretty early, so I don't have an economics perspective. What I've got today to give you is one from the point of view of what we're seeing investors do and some of the issues that we see. So what I've tried to do is to characterise this into 3 phases, and the first phase is really before things got really bad, so before what we are now calling the crisis. I kind of thought it was a crisis from the beginning, but now there appears to be a point where we're saying which is the crisis, which is obviously September, October last year. And prior to that point, what we saw, and not in our client base, but generally I think across the industry, is that the views were pretty mixed. I think people realised that markets had to come down. There was a bit of worry, but there wasn't a lot of panic, and most people were looking at how to capitalise. We got a lot of questions at that time about how can we make money out of this, how can we buy some of these assets which have been beaten up. What then happened, of course, is we saw Lehman's fail and all bets were off, and I think I've called that phase 2, which is from that point to now. And the views are still mixed, but we are seeing much more concern in the client base, and generally you heard Rob Zink this morning and you've heard Doug and Shane today. People are now, there's a scenario you can paint with some reasonable probability, possibly, that things will continue to be quite bad for quite some time. Phase 3 is sort of connected with phase 2, and that's really from a member perspective and also how trustees might react. It's pretty clear we're going to have 2 negative crediting rates in a row. A lot of funds haven't had that before. There were some in the early 2000s that did, but a lot of funds haven't had 2 negative crediting rates, and certainly not this bad. I mean, things are as bad as they've ever been. And trustee responses and member responses to those numbers, I think, will be something we have to handle pretty carefully. So some of the issues that we're seeing, the first one, which I'm sure that you will all be aware of, is just control of your asset allocation. And this really has been an issue even for fast-growing funds, and it's called the denominator effect, which basically is that you've had equities fall by such a large amount that everything else has stayed the same or gone up, depending on what their returns were. So your ability to keep your allocation with any ranges, if you work in that system, has been pretty limited. That said, I think that ranges make sense in certain environments, but there are other environments when you don't necessarily want to be automatically rebalancing, and it seems to us that this is definitely one of those. Liquidity has been a very big challenge for everybody, and I think that one thing that we always know, I think, as investors, is that illiquid means illiquid, like it's the reverse of liquid. And I think that this is a good reminder that when you are invested in illiquid or unlisted assets, they are illiquid and unlisted, and that means that you don't have ready sellers and ready buyers at the right price. You'll find quite a divergence in price. But that said, these are long-term investments, and they can be very valuable parts of long-term investment programs. And that comes back, I think, to a point that I think about a lot, which is that we're here trying to make money for members in the long term. And if we moved everything out of, into anything that was listed, I think then you risk really damaging the chances for good long-term returns through time. I think that you do need a variety of asset classes through time. On currency, this was one that hurt particularly clients with internal currency programs. The dollar, as you would know, fell from about 98 US cents down to about 60 odd. I happened to be on long service leave in Europe when the euro went from about 63 to about 48, and luckily that we'd already had half the holiday, but the last half was basically we just ate and did nothing else because it got very expensive. And so at the client level, what we saw was all these currency programs really needing to be very well managed, and most clients had about 2 or 3 months to handle the planning for getting liquidity, but there were large amounts of liquidity that were required. And that did mean some fairly swift movements for some of the clients. If you're invested in a pooled fund that did all that for you, well, they realised assets or whatever they had to do, and you did see some high-profile products come adrift because they couldn't handle their currency hedging. So this was not something that was solely for the funds, but if you did have your own program, it was an issue. The last one, which has been a bit of a surprise, I think, to a lot of funds, is members have been switching, and we always thought that fund choice would be exercised before member investment choice in this environment. We thought if you had a fund that credited much worse than its peers, you might see members move to other funds. But in fact, what you've seen much more of is switching within each fund. So a lot of money going to cash and cash-type options. It seems to be a bit cyclical. It quietened down a bit over Christmas. It's picked up again now. Statements have just gone out. Maybe that's part of the reason. But you are seeing evidence possibly of some reactive behaviour. I mean, you never know what an individual's doing when they're choosing to move money. Maybe it's the right decision for them ultimately, but for a lot of people that probably won't be the right decision to crystallise all those losses now, move into cash and then need to move back. But I think that creates significant communication challenges for clients, and that's linked, of course, with what will be the second year of negative returns. So looking forward, the things that we think that trustees need to think about, firstly, asset allocation. We all know that it dictates 90% of the risk and a fair proportion of the return. If you can get that right, then you're going to be a fair way of the way home. And I think that you'll see quite a significant divergence in returns depending on how people go on this, because if Rob's Inc is right and we're in a scenario where the world is kind of close to ending, then really all you want are government bonds and gold, nothing else, no equities, nothing. And I don't know anybody's got a portfolio like that at the moment. If you believe in a more, a less difficult scenario, then you will slowly go up the risk curve and bring risk assets into the portfolio, and how you balance those out will dictate how you perform. One of the other challenges at the moment is working out what's in the price. There's loads of charts and things around saying equities are this close to the bottom because this is where we've been before, but that assumes history will repeat itself, and I don't think that we can assume that this time. And what you've seen also is that markets and fundamentals are disconnected. They're usually a little bit disconnected. I think they're very disconnected at the moment. And you saw in the last 12 months that there was really no reward to anything sensible. There was just panic in the market, and it showed in the returns to the stock market and other investment markets. One of the other things we're seeing a lot is what I've written there is throwing good money after bad. There are loads of managers, in particular, for example, property is a key one at the moment, coming back to the clients looking for cash because they're about to breach loan to valuation ratios and all sorts of covenants and things. What we've said to clients is that you have to be prepared to let the failures fail. You can't keep handing money out. If these things need to fail, you ought to let them fail. And I think that's part really what Doug is saying, which is almost a cleaning out of the system. The finance sector will shrink. Some of these things have not been successful and they don't deserve to continue to be supported. But you've got to look at everything in its own right, because some things do deserve to be supported and they can succeed. More fat tail outcomes. That basically just means more unusual events, and I think that we always say, and I always think, you've got to think of the worst case scenario, then think again, because it could always be a lot worse than you think. And I think if nothing, that's what the last 12 months have proven to us, that things could be so much worse than you could possibly dream and you could possibly scenario test for. Like, I remember APRA was asking us to do scenario testing for clients, which we did and have done for a couple of years now. The first one, we had scenarios of equity markets down by, I think, 44%, which was the prior worst number to that point. And I remember thinking, I can't imagine that happening, It just seems so hard to imagine, whereas in fact we've clearly exceeded expectations on that. Not in a good way. Member communication, this is obviously not what we do. We're not that great at communicating with members. We don't write to be able to communicate with members. We write to be able to communicate with trustees. But we are being asked more and more to go out, do member presentations, a lot with people who can do the translation, I guess. But communication with members about these concepts and topics, I think, is really important. And the cash flows to cash are something that really worries me, because I think that means they're scarred. People are very scarred by their experience in super and in the equity markets, and if they lose confidence in the system, then we have an enormous hole to dig ourselves out of. I think also the last 12 months have reminded us that markets are risky, and there are a lot of people in the market who've been there for the last 5 or 10 years, I think, that forgot that. And you see people, young people with margin loans, and they've never known, times when markets went down, and now they have, and I think it's a pretty hard lesson to learn. But it's about communication and education, and I think that you're seeing a lot more of that. You've seen the Barefoot Investor guy on a lot of these tapes, and I think he's obviously making some headway with Generation Y, which is not me, although the Brady Bunch, I'm not sure what that makes me, but maybe just a bit of a dag. Sorry, Shane. But I think that, to me, this is what it comes down to, is communicating with members and making sure they understand why they make decisions. Is it the best thing for them to do? I mean, if you've got the long term on your side, you should use it. But if you don't, then member investment choice is there to be used. But I do worry that it's been used in a pretty reactive way. Thank you.
Superannuation is obviously a tax-advantaged vehicle. In part, we have those tax advantages to ease the stress on the aged pension. And through member investment choice, now this goes to what you were just talking about, Fiona, we see people trying to time the market, and we often see them moving into cash at just the wrong time, and perhaps they're doing that now, and these people will move back into equities after the market has peaked, many of them will, and they're crystallising their losses. Should this be allowed to happen in a compulsory system where contributions are mandated?
You can't take away people's right to choose. I mean, just like you can't save some people from themselves, you can't take away their right to choose. And I think that all you can do is educate them so that they can make the right decision for them based on the circumstances they have at that time. And there are a lot of people that are close to retirement, and if they were in a growth option and have no other money, then they probably ought to have gotten better advice, because the ability for them to recoup these losses is much lower than someone who might be aged 30, who does have another 30 years to recoup the losses. So education to me seems to be the key. I don't think you can mandate to say, no, you can't switch. I mean, you can argue that before we had member investment choice that everyone was fine, and that, you know, we had the trustee being the big brother, and that worked pretty well for a lot of people. But I think if you want people to have confidence in their super and their investment education, you've got to give them the right to choose, but give them the tools to make the right decisions.
Doug, I mean, can you mandate against bad judgment?
Well, no, you can't, and you can't mandate for honesty. You can't mandate for any of those things, but you can regulate against some forms of aberrant behaviour. I guess I've always had a belief in the innate sensibility of households, which is why I strongly hold my views they'll get us out of this. Interest groups of one kind or another inevitably get it wrong. The financial sector, property sector, governments. I guess I'm a bit interested. Just how much switching is going on. I suppose my prior belief, and having talked to some funds, was there's actually a lot less than they thought. And that, there's certainly, if it's 5, 10, 15%, there are people who shouldn't be switching, but I would have thought that most people are in fact holding the line.
Fiona, what?
Well, most people are, in the sense that you've still got fairly substantial proportions in default options and that sort of thing, but you are seeing a trend upwards in the number, but for some funds they are off a low base, but it seems to be that it's doubled from where it was. So if you had, say, 3% of your fund in a cash option, maybe now you've got 6%.
Sure.
But we have a couple of clients where it's as high as a quarter that have switched. Now, that's not switching in the last couple of months. That's been switching over 18 months. And arguably, maybe they've made a good call. I mean, if you switched 18 months ago, that's a good call.
Yeah, you're clever.
You've done right. So look, I think that supports the notion that on average they're doing pretty well.
But how difficult does it make it, say, Shane Oliver, for trustees to make good investment decisions if, with the 30-day portability, they can have their clients switching to cash, and you were just saying, Fiona, as high as 25% in some funds. You've got all this information coming at you. Almost for every speaker there's a different view. And then you've got this volatility by the client base as well. I mean, how do you make good decisions in that environment?
I think that's just something that the trustees have to bear in mind, and it comes. I think Fiona had a dot point there about liquidity. So it's always been an ongoing phenomenon that through good times you see money flowing into the more risky assets or more risky strategies and funds. On bad times it's coming back out and going the other way. So I think that's just something we have to deal with, and I would be against trying to regulate against that, or it really comes back to education. And we've got enough debate going on at the moment about bans on short selling. To extend it to superannuation members or prevent them from selling, I think would just create a huge furore and would be the wrong thing to do.
Okay, let's go to this notion of losing confidence in the system, because as you say, Fiona, with a second year of losses, this is obviously going to be a significant public debate in the coming months. If the role of the superannuation trustee is to act in the best interests of members, and given all that's happened and that members have seen their account balances go backwards, are we acting in their best interests, or is it actually time to reopen the debate on investment policy and say, should we be doing this differently?
I think you should always ask what you could have done better, because you could always do something better. I think it's really easy to fall into the trap of saying, well, we've done this for a long time and it's worked, so let's just see this out and everything will be fine again. I mean, maybe that's the answer, but I think that you have to sit back and say, is this the best way to do it? Does this still make sense? And I think also it's helpful at this point maybe to remind people of what you're trying to achieve. If you're in a typical default fund, your target over the long term will be CPI plus 3 to 4%. If you look back over 10 years for a lot of funds, you see CPI plus 3 to 4%. I think that the return or the risk in that time has been much higher than people thought it would be, and you've seen in that time significant ups and downs. But in the end, all that hard work, and we got CPI plus 3 to 4. And perhaps we ought to just think about what you actually need in retirement, and most people, that kind of number is fine. So I think that if we can remind ourselves what we're trying to do, the time frame over which we're investing, and we've talked about the long term being a series of short terms, and the reality is that it is. You're all judged every month when the super ratings and other service providers put out their numbers. I still think that's one of our industry's biggest oxymorons, that you would invest for the long term but care what happened in any one month. And I think that perhaps trustees could think about how they can get a better message out. There's no sense to me in reporting on a monthly basis when you're trying to invest for 5 or 10 years. And I think that some of the short-term behaviour in the last little while has been what's got us into this mess. So that would be a good thing. The other thing too is you always have to look forward. Every day in investing, you finish the day, you can't do it again. You can't go backwards and redo it. You have to just keep looking forward and assessing the situation as you are now. What do the markets say now? Respond to changes. Be prepared to be dynamic if you need to be. But that said, there are times when it is important to hold the line. You don't want to be, I think, doing things because you feel you have to do things. And one of the biggest risks I see at the moment is that we have some clients that are so worried about their returns that they're saying that everything they've done before is just irrelevant, worthless, let's just start again and throw it all out, whereas my view is a little different. I think you're better off just saying, okay, where are we today? What did we learn? How do we go forward? But don't knee-jerk reaction and no knee-jerk reactions. And I think if you make a knee-jerk reaction now, you run the risk of being whipsawed pretty badly.
Dr.
Yes, Ellen, I don't think the debate needs to be restarted. I don't think it ever shut down, but we will talk about some different things. We've learned through this episode that diversification works great until you really need it. And how are we going to approach that? And maybe the answer to that question, or how we might think about that question, is we need to go back and think about, I think Shane brought this up, what are asset classes? And simply thinking of the boxes we've traditionally thought about and then getting their risk and their characteristics, their return characteristics, and then optimising, we found out that similar more fundamental things drive the returns in many asset classes at the same time. So I think there's going to be a big discussion going forward about what is an asset class, and if you get that right, then you can think about diversification in a way that's meaningful. The issue about dynamic asset allocations popping up, and I have no doubt that that's a good thing, but how often? I mean, the fact that members are switching, they're trying to dynamically reallocate right now, and we're saying perhaps that's not so bad. Rebalancing. How often do funds think about rebalancing and is allowing your SAA, if you have one, to drift because equity markets are going down and you don't like equities? Is that a sensible thing to do? So I think they're the kinds of debates we'll move into over the next 12 months, and I don't know that we've really got good answers to many of them, or any of them, at the moment.
Shane, do you want to jump on that one?
I mean, this sort of debate, I guess, always arises at this point in time, and there was a similar debate back in 2003, 2004. Yeah. And at that point in time, global shares had similar horrendous falls. The US share market, I think, had a top-to-bottom fall of 49%. In Germany, it was something like 85%. And I think there's several points to know. One is it does highlight that starting point matters, and that there is a role for, I think, more active, strategic, or call it dynamic asset allocation amongst in a superannuation fund, probably at the trustee board. But that's a burden that can't be taken on lightly, because just as picking managers is hard, trying to pick markets even over 5 to 10 years is also going to come with its own ups and downs, and you can often find you end up getting bearish too early or bullish too early. I think there's also this sort of event, just what Doug was saying and what I was saying about asset classes, it highlights the importance of both diversification, which we try and quantify and measure, and also diversity. The old concepts of having growth funds and defensive funds, a few years ago might have seemed out of date and a bit like pigeonholing certain asset classes, but it does have some value. And if you look at the assets that have done well through this downturn, they were government bonds and cash. They've worked quite well. And there is a role for those sorts of assets in a portfolio, and they do provide diversity against the growth potential equities offer, and I guess longer-term growth potential but a bit more stability that unlisted assets offer. So we have to think about both of those. But I think at the end of the day, there's a danger here in throwing the baby out with the bathwater. These things happen. I guess we just have to move on, and thinking that we're always going to get every cycle right, I think, is just pie in the sky.
Alan Kohler wrote an article recently which... Oh, there was a hiss. There was a hiss from the audience. There's a collective hiss, in which he had a bit of a look at unlisted asset valuations, and he suggested that unlisted property assets were wildly overvalued given the value of listed property trusts, and that as a result superannuation holders had only seen really the tip of the iceberg in terms of losses. Shane, are listed funds undervalued, or are unlisted funds overvalued? And would you like me to repeat the question?
I mean, my take on Alan's article, assuming you're referring to the one in the Business Spectator, is that it exaggerated quite a bit. Several of the assets he referred to as unlisted there have moved down with the fall in listed assets, including many in the private equity space, and also absolute return funds or hedge funds. So the real focus here, of course, is the unlisted property and unlisted infrastructure to a lesser degree. That's where the focus should be, and the weightings there are much less than what he was saying in his article. My feeling is that listed property trusts always go from one extreme to the other. 2 years ago, LPTs were trading on yields of about 5%. Their nature had radically changed, whereas at the same time, unlisted property was trading on 6.5%. So LPTs had gone down too far. Now, of course, they've sold off, and I guess it's been discovered that they had too much gearing in the process, and parts of their business were too exposed to the economic cycle. So you've seen LPTs fall 70-80% depending on where you're invested. Yes, directionally that's a guide to what unlisted property might do, but unlisted property was never as geared, never moved up as far in terms of the underlying cap rates, or down as far as in terms of the yields, and therefore I think the downside for unlisted property is nowhere near as great as that we've seen in listed property trusts. I think listed property trusts have sort of borne the brunt of investor nervousness and have exaggerated the likely swings that we'll see in unlisted property. So yes, unlisted property will face some downside this year, given that some funds are maybe for sellers, given that their weightings have drifted up, given the rise in yields available in other asset classes, but I don't think it's going to be anywhere near as great as the 70 or so % on LPTs.
Doug, would you agree?
Yeah, pretty much. I think the key connection here is if unlisted assets have their dominant exit strategy in listed markets, then their value will fall with listed markets. Now, it's not clear that unlisted property, big property in particular, requires to exit through unlisted markets, so it's held for very different reasons. You can see the big impacts in, say, certainly large cap private equity, where these deals took on big debt with a view to listing sometime in the near future. Now, they'd have been crucified. So it really depends on why people are holding the unlisted assets and their connectivity to listed markets as an exit strategy.
And Fiona, there was another line in that article: every super fund CEO and chief investment officer knows what's buried inside their funds and what's coming at them this year. Discuss.
Thanks. Well, we work with 20 of this country's pension and other investment funds, and I don't know where that comment came from, but it just seems to me that that was probably designed to, maybe sell a few newspapers or something, because there's certainly the people that we deal with, they're not sort of trying to hide anything from anybody. They use external valuation processes. Many of them have regular valuation processes. I don't think there's anything, lurking in that sense, but I would agree with what Shane and Doug say, is that there's a disconnection between valuations. That will right itself in some way. And I think that it's a bit about thinking, what do you want these assets for in the first place? If you're a long-term investor and you've got a piece of high-quality infrastructure that can't be easily replicated, for example, a major airport or something like that, well, that's in your portfolio for the long term, unless you get a crazy offer for it, in which case everything in your portfolio should be for sale. But you've got to work out what that price is and what are you prepared to give up. So we take the perspective that anything unlisted has to be a long-term investment. We're trying to achieve long-term good investment returns for members. They fit that strategy very nicely, but their prices certainly do get out of whack, and at that point you have to think about, are you prepared to sell and what price are you prepared to sell at? What does it mean if you can't rebuy that asset? Maybe you can, maybe you can't, and try and manage it that way. I will also point out, and this is a bit snippy, but in the week after Alan Kohler wrote that article, the equity market, which is I presume where he was saying everybody should flood, was down 5%. So I'm not sure that Alan's got the answers either. I think that he raises a valid point about valuation processes and things, and I think that most of the funds have reputable, pretty good valuation processes. They're long-term investments. But yeah, I think he was probably just trying to, sell a few papers or, I don't know, media or whatever you do on the website.
I want to run through... I want to run through engines for recovery, because I know the two gentlemen on my left have very different views about China and the opportunities that are presented in Asia. I want to go through what on earth they're doing in the States, which I think Mr Rudd has gone over to find out, as well as briefly looking at the stimulus packages in this country and the effectiveness of those. I'm tempted, though, to pause and wonder whether or not Doug has any favourite members of the Brady Bunch, just to sort of clear off that.
No. I was thinking about that.
Don't say Alice.
No, if we're going to measure our life by TV, I used to watch the Beverly Hillbillies. Is that...
Queensland was another place back then.
Ellie Mae, yeah, right. And Jethro. That's right.
All right. Okay, so engines for recovery. Doug, you're not. You are pessimistic about China, and you've sort of given a bit of an indication as to why.
Yeah.
But I mean, that has been the traditional logic, hasn't it? That China may not be able to get us out of it, but they'll certainly help in the recovery.
Look, it's certainly consensus, and that's always a bad place to start, in my view. With China, I think it's kind of both irrelevant. I view it as both irrelevant and I am pessimistic. Irrelevant in the sense that the US economy is about, say, 25% of world GDP, and US consumers account for 70% of that. So US consumers account for about 20% of world growth. China's about 10% of world GDP, and their consumers account for something a whole lot less of their GDP, around about 20-25. Right. So even if all Chinese consumers got off their bums and started to spend, 2.5% impact on world growth. So it's much, much smaller. And therefore, in that sense, irrelevant. And I think there's a belief that the body politic in China is going to be smart enough and clever enough and quick enough to turn that big economy around. At 10% of world GDP is a big economy, and replace the 45% of world demand for their GDP onto something the Chinese are going to buy. Now, the average Chinese got a fifth of the standard of living than Americans, so they're going to buy the same bundle of goods that the Chinese were selling to the US.
So you still retain your confidence in the Anglo consumer?
Absolutely.
As the great engine of growth?
The Anglo economies, the US, the UK, Canada and Australia, and there's a few Kiwis here, you can throw New Zealand in, I don't care. They are far and away the engine of world growth, and all the other economies are derivative. Now, as the ADB, the Asian Development Bank, showed in 2007, while there's a lot of intra-regional trade in East Asia, including Japan and China, all of their final product goes to the G7, and 60% of it goes to the G3. So when the G3 stop buying Chinese product, China's got no market.
Shane?
Well, I'm not looking for China to save the world here. I think the more likely scenario is that government action will pull us out of this initially, and that's the key.
Domestic government action.
Domestic and also in the US and elsewhere. That's the key. If that works, then that'll pull us out of the depression scenario that some people are talking about. But I think we are into an environment where the US consumer will be constrained for some time to come.
Say that again, sorry.
The US consumer and by definition US growth will be constrained for some time to come.
Right.
If you think about the last 10 years or so, you'd probably factor in, normally you'd say, well, US growth could be maybe 3% over the next decade or so. I think going forward, you're probably better off factoring in something like 2%. Now, so I'm not looking for China to sort of fill the breach left by the US, but I do believe that in terms of investment opportunities, the strength of China combined with India and the rest of Asia is where we should be looking.
And where do you see you made the point in your presentation about opportunities in Asia. Where do you see those opportunities?
Well, I think a lot of the opportunities are in China. I guess float it all back. I mean, I agree with Doug that if the US consumer sort of sails on down and we go into depression, that's going to have a flow-on effect to China, big impact there. But if the US can pull itself out and manage 2% growth, then that's benign enough to enable China to stimulate its consumers. Consumer spending in China today is actually about 40% of Chinese GDP. A few years ago it was around 50 to 60%. So there is potential there for the Chinese to get back to where they were back in the 80s and 90s in terms of consumer spending. Right. And I think they have the ability to do that. Household savings in China is about 40% of GDP. Plenty of potential for that to be turned around. And don't forget that China got to this situation it's in today where it's dependent on exports as partly a response to what happened in the 1990s. In the 1990s, Asia as a whole relied too much on domestic demand. They found they got themselves indebted, they got current account deficits, and they said, we won't do that again, we'll now rely on exports. And of course they now find themselves in the current mess.
Okay, so just dot point for me, when you talk about opportunities in East Asia, just dot point, what do you see as those opportunities?
Chinese equities. The Chinese equity market's currently trading on a PE of about 15 times. At the peak a little while back it was well above that. And I think China has a lot of growth potential going forward. So in terms of return potential, I'd say the Chinese equity market is probably one of the best potential markets in Asia. Indian shares, I think, are a little bit behind that, but still offer pretty good potential. And of course, if you get growth in those two coming through, I think it's going to help the rest of Asia. You'd also be looking at Asian property markets and Asian infrastructure. So my feeling is that if you look at the world going forward, you're probably looking at 2% potential growth in the US, Europe. In Japan, it's probably south of 1%. In Asia, you're looking at potential growth of around 7 to 8%. This is in real terms. That is going to translate into much higher returns from their asset markets, whether they be property, infrastructure, or, in the mainstream, equities.
Okay. Let's just very briefly, in the 2 or 3 minutes we've got left, Doug, is sanity returning to the US banking sector a prerequisite for Australian recovery? What do we need to see to instil confidence?
I think the challenge in the US is working capital for good firms, and that's for most firms. So freeing up of debt markets in the US would be a good thing. At the moment, this is just as an aside, I think it comes back to this question of liquidity. There's been a lot of capital raising in equity markets over the last 12 months in Australia to the US because firms believe they can't go to credit markets to get capital. And what they mean by that is they don't want to go into credit markets and get a haircut by selling their bonds, their corporate bonds at a 20 to 30% discount. So they're going to equity markets and issuing stock there, forgetting, of course, they've had a 60% haircut in equity markets already. So it's kind of a false economy to think that equity markets are liquid and bond markets are not. So, but what would help, I think, is that if debt markets in the US freed up, then good firms will get working capital and they get back to business sooner. I think whatever happens, they're going to muddle through. I don't, I believe in the power of policy in a negative sense, really in a positive sense. So if they keep dithering around long enough, people get impatient and do their own thing anyway.
Shane, can I come to you to comment on what Doug said in his presentation? This is bringing it back home to the Rudd government's stimulus policy. Do you see it as sensible and constructive policy, or do you see it as perhaps sowing the seeds of inflation and similar policies around the world doing similar things and really pushing out onto the future a debt burden and a whole bunch of problems, including inflation and debt?
I mean, those sorts of stimulus policies do raise those issues, but we're starting from budget surplus. We're starting from zero public debt, so that compares to the US, which has 40% of GDP in public debt. Similar story in Europe. So, and of course Japan up around 100% net public debt to GDP. So we're starting a long way behind all the rest. At the end of the day, I think governments have a choice here. Either they stand by and let us roll off into some sort of severe, prolonged recession, depression type scenario, or they try and have a go and do something about it. Keynes told us you've got to do something about it. So I think they're doing the right thing. You can argue about the tic tacs, whether they're spending enough money on infrastructure so far or the payments to households, but I think at the end of the day we need this sort of stimulus. The private sector has taken the economy off the rails. It needs to be put back on. There is a role for government, short term, in doing that. The trick is, in a couple of years' time, when the recovery comes through, to wind that back. Yeah. So short term, I don't see a problem on inflation. Longer term, yes, we've got to wind it back.
And a final question to you, Fiona, in the 45 seconds we have left. We all understand the enormous personal toll of high rates of unemployment, such as Doug and Shane have spoken about. But is there a silver lining as we emerge from a period like this in terms of the strength of individual companies?
That's not really a question for me, probably. Look, I think from our perspective, well, we don't look at individual companies, but if you look at it from the point of view of what happens in recessions generally, is that things that survive emerge stronger than before. The sad thing is that a lot of people have to lose their jobs and people's lives are changed forever, and you can't walk away from that.
Okay, we'll bring it back to your final things. What, as one of the fellows in the video said at the beginning, what are the learnings from this? You had a range of them. Just repeat those again. What do you see as the big lessons out of the GFC?
I think people forgot that you had to work mainly for money. I think people thought that you could just invest and that would be fine. I think that people got a bit greedy and got a bit carried away, not so much in this country, but certainly in places like the US. And I was recently there for work and I was sort of watching the media, and in places like Los Angeles they have pages and pages in the LA Times of foreclosure auctions, and almost all of the houses are these massive McMansions with 5 bedrooms, 5 bathrooms, 5 bedrooms, 4 bathrooms. I mean, most people don't really need 4 bathrooms. 3 would do it. I think people just got really carried away, and the analogy I have, which is kind of gross, but maybe it's a good way to end it, is if you've seen that Monty Python movie with the really, really big guy that just keeps eating and eating and eating, and they keep bringing him stuff and he keeps eating it, and then in the end he just goes, "You better get a bucket, I'm going to throw up." And then it's too late, he explodes. And that's what we've done. I think that we've just forgotten, what we're trying to do, and I think that we got greedy as a whole. We've spent way beyond our means, and now we're paying an enormous price as we tighten our belts and try to get back to some kind of normality. So those to me would be the main lessons. I think just, try to remember in 20 years' time we might be sitting here again and having the same conversation. I don't know, but it'll be something else we did rather than that.
Please thank our speakers, Fiona Trafford-Walker, Dr. Shane Oliver, and Jethro, Dr. Doug McTaggart.